Good afternoon and welcome to day one of the Advanced Market Structure Workshop. And today we're going to be talking about market structure fundamentals. Okay, now, there's in trading, there seems to be a lot of different forms of analysis. And, you know, back in the late 80s when I got started, all everyone talked about was fundamentals and technicals. But even now within the technical aspect, it's really branched off. We got order flow, we got volume profile. Um, you got the ICT stuff, smart money concepts, and today we'll be talking about the market structure fundamentals because it's, even though it says fundamentals, it's really technicals, but it's sort of the basics of market structure that every trader needs to know. And it's from the market structure that that's what you wrap around your order flow, your volume profile analysis around, to help you really get that firm grasp of what the market is doing, where it's going, uh, ideally, and where you can, areas that you can hide behind. Okay, so today's agenda, what we'll be discussing is how institutional traders view market structure versus retail. You, me, we're all retail traders at the end of the day. Even the institutional traders are the ones with that work at the banks, that work at the major hedge funds, the ones that have the deep pockets, right? We unless we're there, we are just retail traders, right? There's big retail traders, though. There's guys that flip 50, 100 lots, 200 lots in the market, but they're still considered retail traders. We're going to talk about break of structure, BOS, versus change of character, chooch, however you want to call it. And to me, on ICT, the guy Mike Huddleston, he's really introduced a lot of traders to these concepts, but he's the one that came up with these name: break of structure, change of character. But really, what it boils down to, it's really a simple analysis of the market. It's sometimes traders like to come up with big fancy names for things when it's just really basic information. Okay, sometimes, oh, break of structure sounds fancy, or change of character. It's just really breaking out of, change of character is basically a reversal. Break of structure is trend continuation. We'll talk about internal versus external liquidity. Where institutions, quote unquote, hunt stops. You see a lot of false breakouts, but understanding where the liquidity is, either internal or external, will help you understand sort of those false breakouts. When people talk about institutions hunting stops, they're really not. They are just pushing the market around. There's a saying where sometimes you got to buy the market up to sell it, meaning if you're sometimes you're getting ready to dump a position, you don't want to dump it when the market's already crapping out, right? You want to sort of artificially inflate it a little bit, to give you sort of a better start in the market. And while the exchanges and the CFTC do a good job of policing the market, they catch a lot of this nefarious activity that takes place. That being said, it does happen. Okay, it does. Sort of these nefarious activities do happen from time to time. We're going to talk about the difference between order blocks, fair value gaps that matter, and again, looking back on charts, you see a lot of these guys, these quote ICT gurus, they like to post charts of stuff that happened that's cherry picked, but really seeing it, on a chart and understanding why it's happening, in my opinion, is the difference. Okay, and I'm gonna just touch upon, why retail traders misread structure and lose money, because at the end of the day, us as retail traders, we tend to be trading on the short term. Um, we're in and out of the market pretty quick, and if you misread what's taking place in the market, you're gonna lose money. That's all there is to it. As much as we like to think that we're the best traders in the world, sometimes even the best traders misread the market. Okay, and retail traders probably more so than any other group of traders. Richard asks, about this being in the Strategic Traders website. Yeah, the difference is you're not going to be live. Okay, so you just get the recording in there. Um, so that's a huge difference. All right, so institutional versus retail traders. Okay, what's the key differences, right? Well, I mean, institutional traders manage obviously large volumes and large money for organizations like banks, hedge funds. They focus on liquidity, the order flow, and minimizing market impact. As small retail traders, we don't care about liquidity so much. We don't care about, well, we do care about what's happening in the order flow because that's what we're reading. And market impact, our 5 lots isn't going to really affect the market that much. But if we're trading 50, 120, it will affect the market. Okay, that's obviously one of the big key differences. Institutional traders, they want to trade based on deep liquidity and strategies that align with big money movements, right? They're often influencing prices directly due to their size. A big trader can and will impact the market, right? If someone has 2,000 E-minis to buy, you can't really hide that from the market, okay? And once that order starts executing through the market, it gets seen by all the other participants, right? And all the other participants are going to react. Some may say, hey, this buyer's an idiot, I'm going to fade them. Others might think, hey, like it's seen in trading places in the orange juice pit, where the brokers are on the side, the Dukes know something, and everyone starts jumping in. Just because a size order goes through doesn't necessarily mean it's right or wrong in the sense of jumping in on it. It's going to help continue it. I said it could be just someone getting out of a position. I got to get out of this position, so get me out. And then that's it. And then the market reverses. So, you have to understand that. But, institutional traders will influence prices one way or the other, short term, definitely, and to a certain extent, the longer term, because it can, create a level. Traders will react because it is volume, right? And we know that volume can act as support or resistance, as stopping volume or defensive volume. Retail traders, in contrast, we just trade our personal accounts with smaller trades, relying on indicators, technical signals, emotional decisions, which rarely impact the market. It's sometimes people say retail traders are like the bugs on the windshield of the trucks, which are the institutional traders. However, advances in technology are narrowing the gap, but institutions still retain that advantage in research speed and scale. And what do I mean by the gap? Okay, is the gap between retail traders and institutional traders. It's still significant, because being an institution, right, you should have an advantage, right? If you got, billions of dollars technically at your disposal, you should have an advantage over a guy that's got $3,000 in his account, right? Because you should have superior research, right? Economists, all that stuff. Your data should be, multiple data sources. Maybe it's faster. Obviously, ultra low latency, high speed execution. CME charges an arm and a leg for hedge funds to have a server right next to their matching engine. Economies of scale, obviously the more you trade, the lower your costs. A big firm can, a big hedge fund, they negotiate these incredibly low execution rates with different brokers. Oh, they'll go to Goldman Sachs. Goldman Sachs will charge you 5 cents a contract. Okay, then they take that 5 cents, they go to JP Morgan. Well, hey, they're offering us this. What can you offer? Well, we'll do it at 4 cents. It's a race to the bottom. So almost like their execution, their costs for execution is nothing basically. And all they're basically paying is exchange fees or something. Whereas retail traders now, for retail traders, its price has gone down. I remember when $20 a round turn was considered like deep discount. Now basically retail traders were paying, we can be paying less than $1 a contract, which is incredible. So that's how it's economies of scale for retail traders is growing. Okay, now institutional traders obviously have influence over order flow and market structure. And what do I mean by that is because their orders are so big, they're going to influence how market structure forms. And as retail traders, we have to understand that it's like a river. Okay, if or you see how a river, like when you're in an airplane, you see how a river winds and winds and winds. That's where a river turns. It depends on sort of the riverbanks, how much water is flowing through it. But as a retail trader, you have no influence on market structure. Okay, the big traders do, because why? They can slow down their buying or selling. They can speed up their buying and selling. If think of it like, you see the little river, right? And then you look up, there's a big dam. There's a big dam holding back all the institutional traders. But if that so much pressure on that, the dam breaks, all the institutional orders come through, the river, the little calm river that you see winding through the hills is just going to be a straight line. Okay, that's the influence that institutional traders can have. They can affect the market structure. Now, Retail Advantage obviously has been growing with tools, obviously access to real-time data at affordable prices. And, I remember, back in the early 90s, when TradeStation was out, I mean, back in the 80s, you had System Writer, but, that was it. It was expensive. Now, with the internet and, these apps, you get real-time data for CME, everything, excellent charting stuff, software, and you're paying like $30 a month or something like that. That's unheard of 30 years ago. Right? I remember CQG. If you want to subscribe to CQG, you'd be paying a lot, $800 a month. You'd be paying $595 just for the basic subscription to integrated client, plus the different exchange fees to exchanges you want. Now, as far as the ability to understand what's happening in the market, right? Sort of the research and stuff. Now we live in this information age where retail traders, also have access to Twitter, and other platforms. I don't want to say Facebook, but because real traders don't post stuff on Facebook, but they can pick up these social cues that are taking place in real time. Sometimes market goes berserko, crypto or whatever, drops 5% in an hour or something. And what do people do is they look on Twitter, right? In the old days, retail traders, they had nothing. They'd turn on CNBC, whatever they're talking about. They probably wouldn't even be talking about the moves because they're just reading from a script. But now we're in this age where retail traders have access to everything. And the gap is narrowing. Technologies, right? Even retail traders have access to algos, APIs where they can connect, depending on your relationship with your broker. You got APIs, you can connect to the exchange directly. Retail prop firms, it lets skilled retail traders mimic some institutional tactics, whereas in the past it was very hard. You had to be sort of in that group, right? You had to be working at a real prop firm. I'm not talking about Apex or Top Step or anything like that. Those are what's considered prop firms. I'm talking about, before is like working for, um, you know, the prop firm groups. But at the end of the day, institutions retain the core edges in scale, speed, information, and capital. And the big money still leads the major trends. That's what causes the trends. It's the big money. We all know that. Now, structure, right? Structure is fractal, whether you look at a minute chart, an hourly chart, daily, monthly, 8-minute chart, 8-hour chart, 4-hour chart. Institutions, what they're looking for, when our market's making new highs, when our market's making new lows. And I've sat on institutional trading desks for decades. What would get our attention the most? Are we making a higher high? Are we making a lower low? Are we making a higher low? Is trend up or trend down? It's really simple. Now the ICT guys, they came up with the fancy thing, break a structure and, changes and stuff like that. But it's just really a simple concept. Higher highs, higher lows. You're in a trend up. Lower highs, lower lows. You're in a trend down. You want to be watching what happens when you break those higher highs or you break those lower lows, because that is what's going to help you understand which way